Hello, everyone. Welcome to another episode of Sam's Corner. And this is a question I get all the time. And I'm going to tell you it's not a question that you can have an easy answer to. The question is, what should I look for when purchasing a stock? And let me tell you, it's not an easy answer. The reason is that no matter what, I know what people are really asking. What people are asking is, how do I know what to purchase? I don't really want any risk, but I want a huge reward. And I understand that. Everybody wants that. But what I want you to understand is, I don't want you to come across or to have the mindset of being a day trader unless that's what you want to do. The average investor is a buy and hold. And what I mean is you purchase a stock and you normally hold it for the long term. And so what I want you to do is try to look at it from that perspective and not from a get rich quick scheme kind of thought process, or I just want to make a lot of quick money fast. That's not normally how it works. Now, can these things happen in the stock market? Yes, they have. Do they normally happen? No. But I want you to have more of a buy and hold strategy. Of course, sell when you need to. And we'll even talk about that at some point, knowing when to sell. But at first, I want to talk about what to buy, what to look for, what to know, kind of what to understand, because I feel like it's important to start to have more of a concept and understanding of a stock and what it is you're investing. So, excuse me. Tip number one, I want you to, if I say read the annual report, you're going to be like, hell no, Sam. I don't like reading. I don't understand it. But this is what I want you to do. Even if you don't want to read it, read it. At least skim through it. And the reason I want to say that is because a lot of times we know a company for one thing, but they may do other things. Amazon has its hand in almost everything. They just recently, I think about a week or two ago, are partnering up with Goldman Sachs to offer their, because Amazon, people have businesses and sell on Amazon, and to offer lines of credit. A couple of years ago, they brought out Whole Foods, and Amazon has just been really positioning itself to be literally the company of everything. So what I want you to do first is, if there's a company you're interested in investing in, at least read the annual report or go online and you can download it, but also learn what the company does. A lot of times we really don't know all of the businesses or all of the brands that are associated with the companies. So for example, this one has gotten a lot of traction for negative reasons, but Yum Corporation, the CEO, well, I won't get into all of that. Anyway, what people don't understand, that KFC, Taco Bell, and Pizza Hut, while they're all different brands, they're owned by one company. A lot of times we assume there's a lot of diversity because we think one brand equals one company, and that's normally not the case. Like with Gap, for example, Gap has Gap, Banana Republic, Old Navy. So a lot of these companies have a lot of different brands. So what I want you to do is take your time to learn what the company does. And also, if you have the time, look at where the company earns a majority of its revenue from. Just because you know this company to do X, they may actually make money in Y. And it's always important to know, to the best of your abilities, what you are investing in, because that goes into another part, but it's also, you're going to become an investor. So you basically want to have some understanding, even if you don't know every single thing about what does this company really do? How do they earn a bulk of their money? And what industry are they in? The next thing you want to look at is, are they a market leader? I normally try to look for those in my when I'm looking for an investment, And even if they're not a market leader, I'm looking for what do they do and what do they do successfully. And some people are like, but how do I, or what's the purpose of that? The thing about it is, market leaders tend to really do well over time, but also they tend to be very solid companies. And when you're starting out, you don't want to get involved in penny stocks and day trading. And there's nothing wrong with those things. Don't get me wrong. I'm not saying they're bad. But when you're just starting out and you don't know, there are just certain things that I think as a beginner investor, it makes more logical sense for you to invest in market leaders and brands that you know and brands that you're familiar with, because then I feel like you'll be able to make more of an informed decision, number one, but number two, you'll also feel more comfortable. And that's another thing. I definitely want you to feel comfortable with whatever company or companies that you will begin to start investing in. The next one is more of a financial one, but I do have, it's a part of another one I have on my list, so I may just lump them together. Do they have a strong balance sheet? And basically, what I'm saying is, do they have enough cash on hand? You do, like, you'll hear some women say, I don't want to date a broke man. I don't want to invest in a company that owes a whole lot of people, that has a whole lot of debt, that has more debt than it can manage. Because the likelihood of it continuing as a going concern, and that's a term that just basically means they can still operate. I don't want to invest in a company that has a high debt to equity ratio. So the debt to equity ratio is basically debt to a company's equity, and the value, the highest, of course, is one. One means that $1 debt equals $1 equity, and you do not want that. What you always want is the company to always have more equity, more cash, and liquidity than they have debt load, because that means when times get tough, they'll be able to survive or at least weather the storm. And what we've seen now with the COVID situation, companies like McDonald's, Amazon, Starbucks, just to name a few, have been able to weather the storm because they have such strong, and Microsoft, they have such strong balance sheets. And that's what you really also want to look into as a first-time investor. You want to look at these market leaders. You want to look at these companies that have been around for a while. I'm not going to guarantee that you invest in them and just automatically the stock price is going to rise, but there's a stronger likelihood of this company being able to maintain itself and to grow over time versus investing in maybe a company that's just starting out and you don't know, if they'll be able to be around in the next 2, 3, 4, even 5 years. The next thing I want you to do is I want you to watch financial news. And I know people are like, I don't want to do that. It's boring. I don't understand it. But here's the thing. I would say at least once a week, just turn to CNBC or Bloomberg or go on the app and read something. Get familiar with the jargon, get familiar with the lingo, get familiar with the terminology. And once you do, then you'll be able to understand what they're talking about. It's important to kind of know these things, especially as you're transitioning to becoming an active investor. Most of us, to be honest, are passive. And by passive, I mean we normally invest because of our 401k or 403b. 401k is for for-profits, 403b are nonprofits, they're retirement accounts, designated based on the company. That's it. But for those of us who are becoming active investors and really looking at stocks and buying you really are going to want to keep up with the financial news. You do not have to watch it every day. Don't watch your stock portfolio every day. Please do not do that. That'll drive you crazy. It'll drive you insane. Just let it be and let it grow over time. Another thing I look at is the price to earnings ratio. And what that really says is what investors are willing to pay for like $1 of earnings. So let's say I'm just going to create, let's say you're looking at McDonald's and it has a price to earning ratio of 13. That means that the current stock price is trading at 13 times earnings. That is a good thing. The higher, the better when it comes to the price to earnings ratio. And there are other ratios. I do say do your research and learn, but I look at that one because I want to look at how are other investors valuing this stock? What are they looking at? What are they thinking? Because I'm going to tell you this, if you believe that the markets are totally run by numbers, nah, not 100%. And I'm not saying they're not, but from a human standpoint, there's always a fund manager. There's always somebody in the background. And we're people. We're not always moved by data. We're moved by our emotions and feelings. And I believe the markets have had the recent rally they have is because all of this stimulus money that organizations have received, making in the mind of some investors that investing is a sure bet. I can invest in, well, airline stocks are down right now, but they're going back up. Also, the cruise lines, because people are even some of the retailers which have been hit hard. A lot of investors are thinking, well, there's this stimulus money out here, and some of them feel like, for let's say J.C. Penney's, who just went into bankruptcy. What some investors are thinking, when they come out of bankruptcy, they'll be positioned better, and I will be, since I'm an investor now, I will be in a better position to make profits, and I would have brought at the bottom. It's not a bad strategy, I personally am not going to do it, but I don't think it's a bad strategy at all, and that's why investing, what I'm trying to say is that, I guess this is my other point, that investing can also be emotional, and not every decision that is to buy or to sell is totally driven by numbers. It could be market sentiment, it can be industry, it could be personal preferences, or in the current case that we're now, where people are kind of hoping that these things will begin to go up and rise as people get outside more, as people go out more, as people feel more comfortable doing things. So it's not a bad strategy. So that's another point. How is the industry performing is the next one. And why I say how is the industry performing is because you want to know, I know this may seem not weird, but a lot of times you won't think of it this way, but if the industry is doing well, sometimes that alone will make a stock go up in price, even if the organization that is in that industry hasn't given any news or hasn't said anything. So there haven't been any, good example. So at one point we're talking about a vaccine, and God, I can't think of the name of the company. God, it eludes me at this point. But they had an HIV medication. It's called Redema something along those lines. And because of those hopes, Merck, other ones saw their stock price rise a little bit because of these vaccine hopes. Again, see something emotional moving markets. So again, you just want to know, how is the industry performing? The airline industry hasn't been doing as well. Retail as well. So look at how the industry is performing, because how investors feel about the industry or how things are going can also affect the stock price and whether people are buying and selling. Another thing you're going to want to look at is earning estimates. And so, analysts, every quarter, companies say we've earned, let's say, $50, or not $50, I'm sorry, earnings per share. So, we've earned 0.5 per share. And analysts will say, well, we expected based on your prior quarters, we expected you to earn 0.55. Well, if you don't meet estimates, sometimes investors will look at that and they'll say, well, they're not performing as well as analysts will have hoped. There may be underlying problems and issues, and it may be time for me to sell. The reverse can also be if a company beats earning estimates, then investors may look at, well, this may be a stock to look at. This is what I want to buy. And the reason I want to talk about earning estimates or focus on that is because these analysts, they know a lot more. They're looking at the numbers, and how an analyst views a stock is highly valued. Now, does everybody agree with them? No, but their thought process does hold some weight. And so those are just things to consider and look for. If a company is consistently beating earnings, they're normally doing something right and on a growth track, which is important. And you can just do a quick Google search to see when was the last time a company reported and if they beat or if they met estimates. And sometimes there are logical reasons why. COVID has affected everything. And so companies some are not making earnings or delaying earning estimates because of that. So those are just things to consider. One thing that is one of my favorite things to look at is what has the company done in the past year, plans to. Have they made a recent purchase? Have they made a divestiture? Are they merging? Are they looking at other acquisitions? Because that'll kind of tell you where the company is. A company that is always acquiring other companies, a company that is making these larger purchases, not all the time, but oftentimes, if they're doing things like, let's say you had a company and you want to invest in them and you notice that they were able to purchase a number of their smaller competitors and bring them in. That shows that this company is really trying to gain market share and also has the money to do so. So those are things you want to look at. You also want to look at, well, what is the company doing? If they have these assets and they're beginning to sell them off, that may be a sign that they have liquidity issues. And you're going to hear people talk about liquidity, basically cash. They may be having cash flow problems and they may need money, or they may be looking to get rid of certain assets in order to position themselves elsewhere. It doesn't always mean a negative thing, but it's always those things to look for, because when you become an investor, you want to kind of know to the best of your abilities what a company is doing. So that's a great thing to just learn. The last thing that I look for is I look for how has the stock performed 1 year, 3 year, 5 years. Year one year, stock price is going to go up and down, up and down, up and down. For 3 years, I may see a little bit, but for 5 years or more, I'm really looking for that general uptick. And the reason is because as a long-term investor, that's what I want to see. If I'm looking at a stock and I'm looking at how it's traded over 5 years and it's up and down, up and down, up and down all over the place, that doesn't show me the stability that I would want in this particular investment. Especially if I'm a new investor, that's the other thing I want to make mention of. And then I'm gonna stop the video. Your level of risk is very important. And no matter what you do, I want you to understand you should always feel comfortable with the investment that you are making. Do not invest money that you need just because you hope it's going to make you more money in the long term. You need to be comfortable with the amount of risk that you're willing to take that's associated with an investment. So that's very important. I'm trying to think of a good example. I want to also give you this example really quick. I don't want this video is longer than I want it to be, but this is a very, very good example. So a long time ago at my job, one of my coworkers, her husband came in and he helped everyone do their retirement plan, and he gave them a 60-40. He gave everyone 60 stocks and 40% bonds. And that's something you never do. And the reason I tell you that is just like there's so many, you hear there's a church on every corner. Well, there's something for everyone. And when it comes to investing, no two people's portfolios should look the same. You have to take into account their age. You have to take into account their income. You have to take account when they're going to retire. There are other factors to consider. And so what I did with one of my friends, and I was like, well, let me see it. And he did. And I looked and I changed it, blah, blah, blah. And he was like saying my portfolio was starting to increase. And I'm like, of course. Well, number one, I know what I'm doing. I'm like, even though I'm not a professional, I know what I'm doing. Number two, you have to tailor it to the individual. And getting back to my point of risk, you have to be comfortable with the level of risk that you're going to take with investing. And that's why you never take your rent money or any money that you need and invest it in the stock market. For those of you who are starting out and beginning investors, you need to be able to invest money that you're comfortable losing. And I know that sounds a little scary because they're like, what do you mean? If you were to lose every dollar of it, would you be okay? And that's the question, the last thing, because here you have to ask yourself, if you lost every dollar of that investment, would you financially be okay, or would you suffer? And if the answer is you would suffer, then you should not invest that. Investing is for the long term. Yes, over time, investments go well, but sometimes investment stocks go down in value as well. So this was a lot longer than I wanted, but thank you all for watching, and I hope that this helps you to just get more of a picture of being more familiar. There's still a lot of other things to consider, but at least with this, you'll at least understand the company, you'll know what they do, you'll understand where they are from a financial perspective, and you'll be able to also understand the industries that they invest in, and most importantly, you'll be able to understand and ascertain if this investment is right for you. And that's the most important thing. Make sure that the investment fits your personality and is right for you. So thank you all for watching. Please like, comment, subscribe, and share with a friend, or even if you don't, still start to have conversations with your groups and your friends about investing. Maybe you all can create an investment club. Maybe your sorority, fraternity, whatever can come together and start investing together and start learning together, because that's what I hope for as well. I want as many of us to invest, yes, on our own, because that's important, but we all should come together. It makes it a lot more fun. It makes it a lot more easier. And it's nice when you have a group of people that you can trust and you're learning about a new topic. I know it's difficult when it comes to money, but I think for the next step, that's what we need to do. So thank you all for watching. I'll see you all next time. Take care.